So we are starting with the paper of May 2019, question 5B, where we should start. May 2019, question 5B is on variances. So the question says that Biashara Limited using standard costing methods. The following information relates to the actual results for the period ended. So we have the units produced, materials used, labor cost, variable overheads, fixed cost, direct material price variance, material usage variance, direct labor rate variance, direct rate efficiency, variable overhead expenditure, variable overhead efficiency, and fixed overhead variance. The standard cost card and the budget for the period were misplaced and could not be recovered. The accountant recalls that the budget output was 7,000 units. So using variance analysis, you are supposed to get a standard cost card for the period ended. So the standard cost card. So the standard cost card. Remember, when you see the word standard, items are expressed on a unit basis. So we will have materials costs. We will have labor costs. We will have variable overheads costs. And then we shall have fixed overhead costs. Fixed overhead costs. Fixed overhead costs. And that will give us the unit costs. That will give us the unit costs. That will give us the unit cost. Those are the items that are required. Those are the items that we require to have. So for us to have that, we must have workings. We must have workings. So the workings will be about getting the variances. About getting the variances. So when I start with the materials, When I start with materials, I'll start by saying material price variance. I'm going to use initials. I hope you are okay with the initials. Material price variance is equal to standard price minus actual price. You multiply by the actual quantity. Are you okay with those initials? Nyambura? Type yes or no, whichever applies. Good. So we are told that the material price variance is 370. So if it is favorable, it means the standard price was greater than the actual price. So the answer is positive. So 370 is equal to standard price that we do not know minus the actual price. The actual price will be given as 35,280, where you can see the actual material costs. You divide by 9,100. Then you multiply. Sorry. You multiply the one for labor instead of materials. Whatever instead of materials. So labor is material price. So we go by material, so it's okay. 8450. You divide by 420. You multiply by 420. You multiply by 420. So when you see to add out, it will be 370 to be equal to selling price minus 8450 divided by 420 is 20. Let's just round with 1 with 20. We can ignore the decimal. We can ignore the decimals. So 20 multiplied by 420. So this proceeds to become 370. You divide by 420 is equal to the selling starting price minus 20. So 370 divided by 420. Okay. Okay, so now whether we needed to have the decimals, because this is giving me 0.88 is equal to SP minus 20. So SP should be 20 plus 0.88, and we can call it 21. Let's just call it 21. Just call it 21. That way. So that is the standard price. Let us go to the next one. Material usage variance. Material usage variance is given as standard quantity minus actual quantity. Standard quantity minus actual quantity multiplied by the standard price. Multiplied by the standard price. So we are told this number, so it was positive 252. It was positive 252. Now standard quantity, we do not know it. Standard quantity we do not know, but we know the actual quantity was 420. 420, and the standard price we have found it is 21. It is 21. So if you take 252, you divide by 21, then you say SQ minus 420. Minus 420. Then you go and say standard quantity will be 252 divided by 21 is 12 plus 420. And that gives us 432 kilograms. 432 kilograms. So that 432, so per unit, Q, SQ should be 432. You divide by the actual units that were produced. The actual units that were produced. The units that were produced is 7,200. 7,200. So you divide by 7,200. So that is at 0.06 kilograms. 0.06 kilograms. .06 kilograms. Let us now go to labor. Labor rate variance. Labor rate variance is given as standard rate minus actual rate. You multiply by actual hours. Labor rate variance is equal to standard rate minus actual rates, you multiply by actual hours. So this variance, it is 1120. It is 1120, which is favorable, so that means it is positive. Standard rate, we do not know that. We do not know the standard rate, but we know the actual rate. The actual rate, the actual rate per hours, and the cost, 35 to 80. 35 to 80. You divide by the number of hours. That will tell you 1 hour equating to how much. 1 hour equating to how much. So you multiply by the actual hours. So this changes to 1120 being equal to standard rate minus the actual rate, 35,280 divided by 9100 is 3.8769. When we use those decimals, they don't stop as more like they did here. So that means the standard rates will be 1120 I need to have divided. Before we get there. Let me not skip. So it will be 1120 you divide by 9100 so that you say the standard rate is 3.8769. So the standard rate then should be 1120 you divide by 9100 plus 3.8769. So let's have that 1120 divided by 9100 plus that answer. I'm getting 4 shillings. The standard rate is 4 shillings. The standard rate is 4 shillings. When you don't launch Missouri. Let's go to labor efficiency. So labor efficiency variance is supposed to be given as standard hours minus actual hours, you multiply by standard rates. Standard hours minus actual hours, you multiply by standard rates. So the efficiency variance is 1040, which is favorable, so that means mathematically it's positive. If it is favorable in kumaanisha, the standard hours are more than the actual, so it is positive. According to our formula here, but not all the times. So standard hours, we do not know them, but the actual hours we know they are 9,100. Standard rate we know is 4. So this then becomes 1040 out of 4 being equal to standard hours minus 9100. So therefore, the standard hours should be 1040. You divide by 4, then you add 9100. You add 9100. So that is giving me 9360 hours. So per unit, the standard hours should be 9360. You divide by the units that were produced. 7,200. The units that were produced. And that gives us 1.3. 1.3 hours. That gives us 1.3. Monica, bye. Oops. So that is labor efficiency. Let us go to variable overheads, expenditure variance. Variable overheads, expenditure variance. Expenditure variance is given as actual labor hours times VOAR, variable overhead absorption rate, minus actual variable overheads. It is given as the actual labor hours times variable overhead absorption rate minus the actual variable overheads. So this then becomes, we are told it is adverse. So if it is adverse, the actual is higher. The actual is higher. So mathematically, according to the way we mark my formula, it should be negative. So negative 2350. Negative 2350 should be equal to actual labor hours, which I do know that they are 9100 times VOAR, which we do not know. Then we minus variable overheads, which are given as that 4,200. That 4,200. That 4,200. So what I will have is that minus 2350 plus that 4,200 is equal to 9,100 VOAR. So if I want to be left with VOAR, then I will say minus 2350 plus that 4,200, you divide by 9,100. You divide by 9,100. So minus 2350 plus that 4,200 divided by 9,100. I get shillings 3.5. Shillings 3.5. Shillings 3.5. That is the way we are. Then, for this other one, variable overheads efficiency variance is given as standard hours minus actual hours. You multiply by VOAR. So this one, so it's not going to add value. It is 910. Standard hours is equal to the somewhere here. 9360 minus 9100 And then this is 3.5. So confirm whether that will agree. Confirm whether that is true. As I saw that something to know. So I hope you have confirmed that there is an agreement. That is 260 times 3.5 is 910. Good. So the last one is the fixed overhead variance. So that must be the total fixed overhead variance. is supposed to be given as standard fixed overheads minus actual fixed overheads. Standard fixed overheads minus actual fixed overheads. Now that is advanced, kumaanisha actual ni kubwa. So we have minus 500 being equal to standard fixed overheads minus actual, the actual is 28,500. So standard fixed overheads should then be minus 500 plus 28,500. That is 28,000. That is 28,000. So per unit, standard fixed overheads should be 28,000. You divide by the units that were produced, which are 7,200. 7,200. So 28,000 divided by 7,200 is 3.89. 3.889. So you can work with that. So with those figures now, we are able to come here and do our standard card. Actually, okay, the standard card would be for the material. You can see per unit required 0.06 kilos. And the standard price is 21. The standard price is 21. So you are then supposed to pay to say 0.06 times 21 is 1.26. Labor is you get the standard hours per unit, 1.3 multiplied by the standard rates. The standard rates is 4 cents. So 1.3 times 4 is 5.20. Variable overheads, you get the OAR, that is 3.5, multiplied by the hours, 1.3. So 3.5 times 1.3 is 4.55. And the fixed overheads per unit, we can make it 3.89. Two decimals like these others. So then plus 3.89 plus 5.2 plus 1.26 is 14.9. 14.9. So with that standard card, then we have the budgets. The budgets for April, for the period ended April 30th of April 2019. April 2019. So again, you will have material costs. Then you have labor costs. Then for the overhead costs, we have the variable. We have the fixed, and then total. So the difference between standard and budget is that standard is given per unit. Standard is expressed on per unit, but budget is given for the entire activity level. So the budget activity level we are told was 7,000. So you are supposed to be saying 7,000 here, 7,000 here, 7,000 here, and 7,000 here. You multiply with the standard costs 1.26, 5.2, 4.55, 3.89, 3.89. So 7,000 times 1.26 is 820. 7,000 times 5.2 is 36,400. 7,000 times 4.55 is 1,850. 7,000 times 3.89 is 27,230. So plus that 1,850 plus that 6,400 plus 8,820 is 1,4,300. Are you okay? We go to the next one. Yes, Monica. Yes, the Buddha. So let's go to the paper of November 2018. So you're looking at November 2018. Question 1B. Duro Limited has two production departments, MM and LM, and two service departments, PP and QQ. For the month of August 2018, the budgeted hours and costs were as follows. The service department costs are apportioned to the production department as follows. The overheads of the production departments are absorbed into product costs using a rate per hour. During the month, we are given that the overhead to be charged to the production departments at the amount of over or under. So the question is on overheads, question 1B. Is on overheads and we are not told which method to use. We are not told which method we should use to share the costs. We are not told which method we should use to share the costs. So, if we are using the simultaneous equations method, using simultaneous equations method, or the so-called algebraic equation method, we normally say let X to be the total costs total costs of departments PP. The total cost of department PP. Then Y to be the total costs of departments QQ. So that we say then X will be equal to X will be equal to, you take the cost of X, which is then 800, plus what PP is going to receive from QQ. Ukifuata hii spreadsheet that is here, you find that PP is going to receive 20 from PP, I mean from QQ. Ukifuata hii row ya QQ, QQ will give 40 to MM, 40 to MM, and 20 to PP. So it's going to be 0.2 Y. And then Y, you take the cost that is there, 7,200, plus, ukifuata PP now, you will see it will give QQ 0.3. So 0.3x. Actually, what's opposite? You can see these two are opposite. These 3 x, these 2 y. They are opposite of each other. They are opposite. So on solving, we will say that X is 10,800 plus 0.2y. So Y is this one, 7,200 plus 0.3x plus 0.3x. So X is then 800. If you take your calculator, you will get 0.2 times 7,200 is 1,440. Plus 0.2 times 0.3 is 0.06x. So x minus 0.06x is equals to 10,800 plus 1,440. So this one, when you subtract, you be left with 0.94x being equal to 10,800 plus 1,440. 12,240. And based on that, if you divide by 0.94, you get 13,021. Yes, for reapportioned as follows. Reapportioned as follows. Reapportioned as follows. So department MM Remember this X is for PP. X is for PP. So ukifuata hapa kwa PP, unapata PP is giving 50% to MM. So 0.5 of 13,021 and NN is getting 20%. So 0.2 of 13,021. Remember, when you are using the simultaneous, we only apportion to production departments. We only apportion to production departments. So this one, we can round it up to 65.11. Then 0.2 of 13,021. We can talk of 26.04. Then, so now, y should be equal to, we now look for y. It should be 7,200 plus 7,200 plus 0.3x. And we know x is 13,021. We know x is 13,021. So it will be 7,200 plus 0.3 times 13,021 is 11,106. Reapportioned as follows. The apportioned as follows. Ukifuata MM, utapata from QQ it's getting 40%. So 40% of 11,06. And then NN is getting also 40%. So 0.4 of 11,106 is 4,442. 4,442. So now, we get actual overheads. Actual overheads, distribution, kits. distribution sheets. So here we have the overheads. We have the allocated. Then we have reapportioned. And this is from PP and QQ. Then we have the total. So we have department MM, NN, PP, and QQ. So allocated, which are actual, it is 43,200, 52,200. This is then 800, and this is 7,200. Then from PP, which was our X, this one received 6511. This one received 2604. And what we were doing, we were reapportioning this 10,800. Hope you can see where we began, the 10,800. So hii ndio tulikuwa tunatafuta. So unaiweka hapo in brackets, na huyu hakuna kitu anapewa. QQ does not receive anything. Haya, huyu mwingine anapata 4442, 4442, nothing here, and then we have this one. So 43,200 plus 6511 plus 4442 is 54,153. 52,200 plus 2604 plus 442 is 59,246. So we are through with getting the actuals. The next thing that we need to get is overhead absorption rates. Overhead absorption rates. So hii tunaweza igawa namna hii. We have the departments. And the formula will be budget overheads. You divide by budget hours. That is the one that will give us the OER. That is the one that will give us the OER. That is the one that will give us the OER. Budget overheads divided by the budget base, which in this case is the hours. So MM, ukiangalia hapo juu, we are told the budget was 45,000 and the hours were 1,800. MN, the budget overheads were 54,000 and the hours were 5,400. So this is shillings how much? Let me see what I get together. Oh, good. Monica, 25. Na huyu mwingine. The next one. 10. Good. 10. Then we have another table that I want to call analysis table. Analysis table. These analysis table, I will have the overhead here. Then I have MM and NN. MM and NN. So the overhead absorbs is also the other word for charged. So this is now the time we are giving the answer for Roman 1. When you see the word charged, it is the other word for absorbed. And how do you get the absorbed? It is the OER. It is the OER times the actual outcome of the base. The base was hours. And if you look at the actual hours were 1980. 1980. 1980. actual hours were 1980. So when you multiply 25 by 1980, the answer is 49,500. You go to MN, do the same. The OER is n times 6120. So this is 21,600. 21,600. Then you bring the actual. You bring the actual. The actual is this is 54,153. And this is 59,246. 246. So if you could call this one A, and this one we call it B, then you have the offer or the other absorbed. The offer or the other absorbed. And that will be A minus B. A minus B. And the other will be brackets, will be negative. Not all the times, but according to my formula, the other will be brackets, or will be the negative. So if you say that, then 49 minus 54, 153 is negative 4653. So this is an adder absorption. The absorbed were less. That's why we call it adder. Adder absorption. Now you have given 61,200 minus 59,246 is 1954. So that one is an over absorption. Over absorption. So those are the two answers. Are we okay? We move to the next question. Good. So, question 2B. Kuni Limited are distributors of 2 cooking gas cylinders, MECO and 13C. MECO weighs 6 kgs, while 13C weighs 13. The following information relates to the company's projection for the year ending. We have sales, fixed cost, variable cost, operating profit. Sales, fixed costs, variable cost, and operating profit. Determine the break-even point of MECO and C in both units and in shades. So that question 2B, question 2B is on CVP analysis, or known as break-even analysis. Break-even analysis. So the first thing is break-even point in units. Break-even point in units. If we are told to compute break-even points in units, we normally say XBE is the fixed costs. You divide by the contribution margin. You divide by contribution margin. You divide by contribution margin. So if you come to MECO, I have the product here, and then the break-even point units. I start with MECO. So maybe before I get the break-even point in units, I needed to have gotten we need to get we need first of all to get contribution margin. Contribution margin. And then we get the break-even point in units. So contribution margin, we know it's price minus variable cost. It is price minus the variable cost. So because we are just given the total, Tachukua hii 49,056, you minus the variable cost of 29,433.6. And because they are in thousands, you will divide by 43.8. You divide by 43.8. Then when you come to that C, sales are 142,350 minus 42,705. So hii inatupea total contribution. Total contribution. You divide by the units. You divide by the units 71.175. So sasa hii ni 49,056 minus 29,433.6. Divide by 43.8. 448 at 142,350 minus 42,705. Divide by 71.175 is 1,400. 1,400. Remember, contribution margin is the selling price minus variable cost. But you can get the total contribution, you divide by the units, you still get the same answer. You still get the same answer. So the break-even point now. The break-even point in units. The break-even point in units is the fixed cost is 9,811,200. So you divide by 448. Na huyu mwingine ni 79,716,000. You divide by 1,400. Divide by 1,400. So this is giving me 56,940, 98,11,200. We divide by 448 is 21,900. Huyu mwingine, I need to have the product, the price, first of all, we need to show the formula. So let's go to the next. Break-even points in shillings. So how do we get it? RBE. It is given as fixed cost. You divide by contribution margin ratio. Contribution margin ratio. Contribution margin ratio. So how do you get the contribution margin ratio? Contribution margin ratio is given as contribution. You divide by the price. You divide by the price. Divide by the price. You can either work it in total or by units. And I want to go by units so that once again I come here. I have the product here and selling price. So when I go to MECO, and then 13C, how do I get my selling price? For MECO, we know the revenue is 49,056. So you divide by 43.8. Now we mwingine 142,350 divide by 71.175. So now give me the selling price for MECO. Give me the selling price for MECO. Give me the selling price for MECO. 1120. Monica. Give me the selling price for 3C, 13C. 2,000. So hiyo naitaifungia hapo alibia skills yangu hapa, so that I still proceed and prepare another table like this. I have the product now. I get the CMR and I get break-even points in shillings. Break-even points in shillings. So for MECO, I hope my space should be enough. That space will not be enough. So for Meko, the contribution was 448. The selling price is 1120. Huyu mwingine 1400 and 2000 and 2000. This is 13C. So the CMR will be 448 divided by 1120, 0.4. 1400 divided by 2000 is 0.7. So the break-even point to change should then be the fixed cost. 9,811,200 you divide by 0.4. And this other one, 79,716,000 you divide by 0.7. I'm getting 113,880. 98,11,200 divided by 24 is 24,528. So that is how you get the break-even point. You could also have gotten the same answers. You could also have gotten the same answers by taking this break-even point in units, this one, times the selling price. Ukichukua hii 1120 times this, it should give you that 24. Ukichukua hii 56,940 times 2000, it should give you that 113,880. So it could also have worked that too. So we have answered part 1. Part 2 now. Given that customers will bill Meko 3 times for every 2 times they fill 13C, compute the composite unit contribution margin. So composite unit contribution margin. Contribution margin. This is what we generally refer to as weighted average contribution margin. The word composite means combination. The word weighted also means combination. So they mean one and the same thing. So WACM will be given as the weight of product 1, contribution margin of 1, plus the weight of product 2, contribution margin of product 2. Product 2. That's how we get the weighted average contribution margin. So tunaambiwa Meko, which is our first product, it is bought 3 times, when the other one is bought 2 times. So Meko is bought 3 out of 5. So for every 5 items on the user, for every 5, 3 Meko. So times the contribution margin of Meko, 448, plus huyu mwingine 2 out of 5 times 1400. Times 1400. So if you take 3 times 448 divided by 5 equals plus 2 times 1400 divided by 5 equals getting 828.8. That is the composite. 828.8. Determine the break-even sales in shillings. Assuming that MECO and 13C are normally purchased in the ratio of 1:1. So when you're dealing with multiple products, for multiple products, RBE is given as F. You divide by WACMR. So WACMR will be the weight of 1, contribution margin ratio 1, plus the weight of 2, contribution margin ratio of 2. So this one, we are told the ratio has changed. The ratio is 1:1. When you are in shillings, you can even say in shillings, the weight is given in terms of the sales value. So the selling price of 1 MECO is 1120. Ukiuza moja tutapata 1120. Alafu tukiuza huyu mwingine wa C tutapata 2000. So that is how you get the ratio. The weight. It is now in terms of money. It's in terms of money, not in terms of units like we had here. So times this CMR 0.4 plus huyu mwingine atakuwa 2000, 1120 plus 2000 multiplied by 0.7. Multiplied by 0.7. So work out that and give me the ratio. Check whether you get 0.5923. Give me your answer. Yes, Nyabura, and we are in agreement. So if we are in agreement, it then follows that RBE should be the fixed costs. So fixed costs now, because we are dealing with the two products, we will have to combine it. We will have to say 9,811,200 plus this other one, which is 79,716,000. You divide by 0.5923, and the answer I'm getting 151,149,818.2. Are we okay? Yeah, good, good. Yeah, we may differ kidogo depending on how we have rounded. Yeah, we may differ kidogo too because of the rounding, but it's okay. Let us for the few minutes remaining. So now we have like 14 minutes. We can choose. We can go to question 3. Question 3A. Let us go to question 3A. So question 3A is on cost bookkeeping. And I want us just to open those accounts as they have been required. We open those accounts just the way we have been required. So, for the left to draw the relevant accounts, you should just confine yourself to the ones that have been asked. So this is direct materials, control accounts, work in progress, control accounts. I have finished goods, control accounts, production, overheads, accounts, one year of finished. One like there were 6, 7. Okay, so this one now is called costing, profit and loss accounts. Profit and loss accounts. So we don't need the others. We don't need the others. So to ensure that maybe I have enough space. To ensure that I have enough space, wacha nibadilishe zangu in terms of order. Wacha nilete the work in progress here so that I'm not squeezed. Work in progress account. Nitoe hapa. Nitoe hapa. It's good job. The order does not matter. I'm only trying to ensure that I'm not squeezed. Not squeezed. So have you drawn the accounts? Okay. Let's start the working. So to answer for additional information, where we are told, as at 1st of this October, the opening balances for the cost ledgers were as follows. So direct materials, which is an asset, balance brought down here, balance brought down, work at 15,000. 15,000. Then work in progress, which is also an asset. Where the balance brought down is 120,000. 120,000. Finished goods, which is also an asset. Balance brought down is 72,000. 72,000. The following transactions took place. Direct materials purchases. When you buy materials, you debit the materials account and credit the finance ledger, which is not here. So we will come here and say, because of financial ledger, Because of the financial, we have 89,000. 89,000. Materials issued to production. When you issue materials to production, you debit work in progress and credit stocks. So let's start with the stocks. Because of work in progress, tumetoa 90,000 tupeleke where production is taking place in the work in progress. So because of materials, tumeleta 90,000. 90,000. Direct labor paid. When you pay direct labor, we debit the wages account and credit the finance. Now those two, they are not here. But after you have debited the wages, you cross it to work in progress by debiting work in progress and crediting wages, so that you show that you have paid. So however, because of wages, so hii imetoka kwa wages, because of wages, tumeleta 56,000. 56,000. Then the same argument would be said for the indirect wages paid. Indirect, they belong to the overheads. So because of wages here, indirect, hapo tumekosea ile ilikuwa 102, hii ndio 56,000, hii ni 102,000. 102. Yes, Monica. 102. Production overhead cost incurred. When you see the word incurred, it is the other word for paid. It is also the other word for actual. Incurred, paid, actual, they mean the same thing. So when we pay, we debit the overheads, credit finance. So tuanze hapa. Because of financial, we paid 159,000. We do not have the financial account. We don't have the financial. Then we have sales. When you make sales, you debit the finance or financial and credit sales account. So those two are not here. After crediting sales account, you cross it to P&L by debiting sales and crediting P&L. So tutakuja kwa P&L, which is here. Because of sales, we have 650,000. Because of sales, we have 650,000. Goods transferred to finished goods stock. When you finish production and take to the finished goods, you debit finished goods and credit work in progress. So to answer for work in progress, we are going to the finished goods. This is being taken to the finished. We are going to finish and tunapeleka huko 385,000. Then tukifia hapa kwa work kwa finished, Tuseme tumepokea 385,000. We have received 385,000. Now, as at that 1st of October, closing balances were as follows. So, direct materials. So, hapa karibu na mwisho, andika balance carried down. Balance carried down is 14,000. 14,000. Work in progress, hapa karibu na mwisho. Balance carried down is 135,000. And for the finish, balance carried down is 54,000. That is all the information that we are given, plus the one that is up there, and we'll see how to go about it. So with that scenario, you need to check whether each account has received everything that it should have received. So to answer that, material is supposed to receive 3 things. The purchase, which is there, direct material, which goes to work in progress, and indirect, that goes to overheads. So, however, we don't have the overheads. Let's check whether that is the balancing figure. Or first of all, we should have gotten the balancing figure by saying 15 plus 85 minus 90 minus 14. So the balancing figure is not even on that side. Is not even on that side, but on this side, 4,000. So let's remove this one. So if it is on that side, then it represents what we call a gain. What we call a gain. Kama nimefanya vibaya. 15 plus 89 is 104. So in the balance actually. So in the balance. But what I was saying, those 2 points before I mentioned, if the balancing figure would be on this side, it would have gone to the overheads. Kama ingekuwa hapa, it would have been a gain which should go to P&L. But now naona zimebalance kabisa. 104, 104. So hii kifungu imeisha. Twende kwa overheads. So overheads. We are not told how much was the balance carried down. And there is no way it can be carried down before we take it to work in progress. So this full balance should go to work in progress. 56 plus 159, 215. So go to work in progress. Same because of overheads. Tumeleta 215. So let's go to work in progress. What are you gonna cut? Plus 102 plus 90 plus 120 minus 385 minus 135. So there is a balancing figure of 7. It is a 7,000 here. So that balancing figure must be an abnormal loss. Must be an abnormal loss. You see this on the debit side. So this one should be taken to P&L as an abnormal loss. And then you come here because of work in progress. You bring 7,000. You bring 7,000. Then obviously this one, the balancing figure is the one that should go to P&L or cost of sales. To P&L as the cost of sales. So we will say 72 plus 385 minus 54. It's 403. So that 403 comes here to P&L. So because of finish, we have 403,000. 403,000. And with that now, we are able to report that there was a gross profit. So plus 7 minus 650, a gross profit of 240,000. So that is the way it should be happening. I thought to be able to finish question 4, but time in Qatar. It's already 8 minutes past 1. So are we okay at that point? Okay. Can we extend kidogo tumalize A4? Ama you have other engagements? Monica says yes. Nyabura, what do you think? Okay. All right. Thank you. At least talk to kusema hiyo karatasi imeisha. Because today the practice. So look at the question. So question 4 A, we are told each Tech Limited manufactures castings which are transferred to the machine shop of the same company at standard prices. A standard costing system is applied. Basic standards in regard to material stocks are as follows. So we have the mixture, the standard prices, the opening and closing stocks, the total purchases, the mix melted to the standard loss, and we have all that. So let's start with the material price variance. So material price variance is given as standard price minus actual price. You multiply by actual quantity. Material price variance is given as standard price minus actual price, you multiply by actual quantity. So when you go to material Y, ukiangalia kwa information 2, you can see the standard price was 480. Lakini ukiteremka kwa information 4, you can see we bought at a cost of 146,500 and we bought 300 kilos. So if you divide, that will give you the actual price multiplied by the actual quantity. We are supposed to we have 300. We have the opening and closing stocks, the materials purchased. We are supposed to get the actual quantity that was used. So hapo tutaiacha kwanza, tutachora budget ya kwanza iache hivyo, tukuja kwa Y, we do the same thing. Tuseme standard price is 130 minus hizi zilipaiwa 12,500. You divide by 100. This actual quantity is the actual quantity used in the production. So quickly we need to prepare materials used, budget. Materials used, budget. So we will have details here. Material usage or materials used. So obviously we must begin with the opening stock. We add what we purchased. You add purchased. You less closing stock. And this will give you units or use. Units used or usage. That is how you are supposed to add. How you are supposed to argue. So this is Y and this is X. So Y, the opening was 100, and X, the opening was 60. Purchase, hapa tukanunua 300, na huyu tukanunua 100. And the closing was 110. Na huyu ni 50. So if you follow the formula that you have given, it should be 100 plus 300 minus 110 is 290. Na yule mwingine 60 plus 100 minus 50 is 110. If you remember the question we began with ile ilikuwa ya variances. Tukishapata like what we called the standard quantity and standard hours, we were dividing by the actual units produced. Zile zilikuwa 7200. So that's the same concept. You are supposed to use what was used or the number of units that were produced. And now that in this question we don't have production, we can only go with the kilos of materials that were used. So that required you to prepare that budget. Having said that, we get answer to be happy to sell 290. Now you to sell 110. Your will is 146,500 divided by 300 is 483. So 480 minus the answer times 290 is 2416.67, and this is adverse. You don't keep on showing the sign, but you may require to know the sign what it is, like you saw in the other question that we did. If you are going back, you are reconciling. So it is adverse because hii price ni kubwa kuliko hii. The actual ni kubwa. Kuja kwa huyu ni 130 minus 125 times 110. So this is 550, which is favorable. And you can add the two of them, 2416.67 minus 550. It will be 1866.67, which is adverse. If you combine them, which you should. Yeah, so the material price variance here. Material price variance. That one. Huyo mwingine anaitwa material mix variance. So material mix variance is given as revised mix minus actual mix. You multiply by standard price. Revised mix minus actual mix. So maybe first of all, actual total is 290 plus 110, and this is 400 kilograms. Because that's where you must start. Once that you do the actual total. So now for material X, So X is, according to the standard mix, there is 70%. So 0.7 of 400 minus 290. You multiply by the standard price of 480. Y, according to the mix, it should have brought 30% of the 400 minus 110. Starting price is 130. So, nastahili kusema, device mix, we are simply checking if our plan was maintained, how many units you should have got. So, kama hii ilifaa kuleta 0.7 times 400, we get to pay at 280, but we used 290, so minus 290. So, tulitumia mingi. So, times 480, so this is 4,800, which is advanced. 4,800, which is advanced. 0.3 times 400 minus 110. So hapo tunatumia kidogo. So this is 1,300 people. 1,300 people. So this is 3,500 advanced when you combine it. And finally, material yield variance. Material yield variance is given as standard yield minus actual yield. Standard yield minus actual yield. You multiply by standard unit material costs. Standard unit material costs. Standard yields minus actual yields. You multiply by standard unit material costs. Standard unit material costs. Oh, so now after 400 imepeana kwa information 5. Kama nilikuwa nimeona hiyo, you don't need to the 400 imepeana hapo kwa information 5. So this one inakuwa very simple. You see, we are told by information 6, we expected a loss of 10%. So the standard yield should be 90%. The standard yield should be 90% after we taught 10%. So you are supposed to say 0.9 multiplied by the 400. That's how you get to appear how many units you should have gotten. You minus what we actually got, 375. 375. Sasa, you go and combine, or rather look for the standard material cost. So the standard material cost should be arrived at easy. We are mixing two items, X and Y. And X, it costs 480. Na itakuwa 70%. So 0.7. Alafu, sorry, that was Y. Y is 70%. Right? Oh, I hope I will not confuse these things. Naona hapo amekujua. I hope I'm not confused. X ndio 480 na iko na 0.3. Kama nime-confuse you was yeah, you have gotten the concept. So tumechanganya, but we have to proceed that one. Then this other one is 130 times 0.7. So maybe what we shall do, so that we don't lose the concept. After you get the definition, so that I am in line with what I should have done. That's what we shall do. Because pale juu walipea yx, enda ukibadilisha, tuko tunaanza na yx. So hata hapo kwa prices, ukijue, hapo chini kwa stocks, ukijue benefits, ukijua hapa yx. Na hapa tu kwa purchases ukijue. Ukishapigwa hiyo itakuwa sawa. So I multiply by 0.7 and here I multiply by 0.3. And that is very good. That mistake is very good when we are almost going to the exam. You should be very careful. The trick, the examiner anatumia. Hiyo kujua. Okay. So give me the answer now. Itakuwa 0.9 times 400 minus 375. So times into brackets for 80 times 0.7 plus 130 times 0.3 is minus 5625. Now that it is minus, kumaanisha actual ni kubwa. So if you get more yield than what you expected, then that is favorable. If you got more than what you expected, it is favorable. So are we okay? If we are okay, type the word okay so that we can now quickly finish. We will begin. Good. Let's go to part B. Okay. So batch costing statements. Batch costing statements. Tunaambiwa the following information was obtained from the books of brickmasts, a company making bricks. So we have materials. Let's start with materials. Materials costs. Materials cost will be 1800 times 40 times 40. So if you get your calc, 1800 times 40 is 72,000. That is material M. Material N is 45,640. Then you come to labor costs. Labor cost, we have direct 25,560. We have indirect 8,640. We have royalties. Royalties are direct costs. Royalties, we are told it is 0.5 per ton. So we need to know how many batches were produced. The production should be, the opening is 800. So we should begin by saying sales. Sales is 7,400. Not 7,400. 7,400. You divide by 400. Let's get those sales quickly. The production is quite happy. You divide by 400. That is, I think given is shading some. Production. I think we may not be able to proceed with that because I'm not able to see whether this one is giving me 18,500. Then we do not know whether these ones are given in terms of shades or units. But you can still proceed to sell 18. Because I'm not able to know the unit of the opening and the closing. You have to multiply by 0.5. I would have said 0.5 times production units. Then format times production unit, which we do not have. So Sasa here, they would have enabled us to get something called prime costs. Let me give you the format. Prime cost. Now, prime cost, we cannot now get it because this one is missing. Then you bring factory overheads. Factory overheads. So factory overheads, we are told they are 25%. They are 25%, 25% of direct wages, 25,560. So get that, Useme 0.25 times 25, 560 is 6390. 6390. Ukishaweka hiyo, the answer you get is called production costs. Is called production costs. The answer you get is called production costs. Then, how again you bring the non-production. Non-production, they use it into office overheads. Office overheads. So office overheads, they would be 0.2 of wax costs. Wax cost is the other name for production cost. The other name for production cost. So tukiweka hapo, tukishaweka hapo, tupate a figure called total costs. We get a figure called total costs. After you get total costs, if there was any opening work in progress, you say add opening work in progress less closing work in progress, so that you get cost of finished goods. Cost of finished goods. So kama tumekuwa na figures, hivi ndio tumekuwa tunaendelea. Na hii huwa inafungiwa kwanza. Ndio unaifungia hivyo. Ndio unaifungia namna hiyo. Ukishafunga, tunateremka hapa, unasema sales. Sasa hiyo sales tumepewa hapo, inatusaidia after what we needed. Unaleta hiyo sales. And you can see the figures are incomparable. I think whoever sent the question forgot to give us this correct figures. Because you see, this is 7 million and these are just thousands. So the figures are not comparable. But for the purposes of record, I think a 7,400,000. Then you say less. That's how you say less. Nateremka tu. Kwanza unaleta opening stock. Opening stock. So opening stock ni hiyo tumepewa hapo 800,000. I think is in shillings. Then you bring production. Production to be costs. All right. Cost of finished goods E. Is sasa ndio tumeleta hapa. So that we get closing stock. Closing stock tunaambiwa ni 600,000. So to get less hivyo. Sasa tukisha less hivyo tupata mtu anaitwa cost of sales. Sasa mtu huyu anaitwa cost of sales, naletwa hapa. You subtract from sales and that gives you gross profit. That gives you gross profit. And we don't have anything else. Yeah, so that is the profit that you are asking. But unfortunately, the question is incomplete. Then the cost actually to share as of now. So if we had the full figures, ungeipanga namna hiyo. That's how inapangwa. So we then call it at the above juncture. Ama time imesonga sana. So mine is to wish you all the very best in the forthcoming exams. I believe that we have prepared you for what is required. And I also believe that you are doing what is necessary on your side. And when you combine those two together with involving God, what you're doing, I believe that you register very great success. So I wish you the very best. And we also want to thank you for being our students. We don't take it for granted. We know there is many other places that you could have chosen to go to, but you chose to come to Destiny. So we thank you so much. And we still want to encourage you to join us in the semester that is beginning on 26th of this month, so that we continue with section 3. Also market the school to the extent that you can. We are grateful. So thank you so much. God bless you. Have a nice weekend. Thank you. Thank you.